This is the latest HLB webinar, accurate as at the 8th of April, 2 p.m. Things are moving very quickly, so this is where we are today. So, topic of today's webinar is what should your business be considering? We've got a panel of experts on the line to take you through some things. So we've got Todd Gammel, who's a partner in the Restructuring and Risk Advisory Group. Jolyon, who's a tax partner, and James Macfarlane, who heads up our debt advisory group. My name's Simon James, and I'm moderating today to the best of my ability, and hopefully we'll see how that goes. So agenda today. So Todd's going to talk about managing the risks to your business. Following that, Joel's going to take us through JobKeeper, what we know as at now, and the employee cash boost. And then James is going to talk about managing banks and liquidity. The idea is we'll get through the sessions relatively quickly, probably about half an hour or so, to allow plenty of time for questions and answers. Now, just while we're doing that and the last people are joining, we've got some kind of pulse polls throughout the day, so I'll launch the first one, which is how seriously is your business being negatively impacted by coronavirus at this point. So I'll launch that poll now just to let everybody kind of get in the swing of things. Hopefully something's popped up on your screen. So a 1 to 10 in terms of, I shouldn't be watching this live, it's coming through very quickly, and unfortunately it's more to the top end than the bottom end of the serious impacts there. You'll also notice on your bar there's a Q&A tab as well, with some which is obviously the questions and answers. So as you go along through the presentations today, if you can put your questions down in there, then I'll moderate a Q&A session towards the end. So please use the Q&A and not the chat box in terms of the questions. Excellent. So without further ado, I am going to hand over to Todd.
Thanks, Simon. Good afternoon, everybody. Thanks for taking the time to attend. I'll work through quickly some of the things that we've been suggesting for a couple of weeks now, and people are starting to turn their minds to as things are calming down, and then some other things that, as part of what we have been doing with some clients that are coming up as things to explore which improve your position. So basically what we see from our side, thinking through this process and out the other side into a post-hibernation period, is there needs to be a plan. And the basis for that plan is to build it back very simply and understand where your starting position is and what your current financial position is, looking at your debtors and your accruals and your lodgements and all of those things, and understand where you are. And some people are finding that really helpful because it gives them something to do rather than worry. They're working through an actual process. So they're coming to the end of that, and then they're looking at the next phase, because that gives you your base model and where you are, and then what is going to happen over the next 3 to 6 months and how your costs to continue are. Some businesses are in hibernation, obviously, and hospitality, restaurants and whatever else are in hibernation mode. So they're just looking at that and seeing how they can manage through with minimizing their costs and keeping the business going while maintaining as many of their staff as they can. And JobKeeper will obviously impact that and is almost pretty much designed to try and impact on that pretty positively very quickly. So I think that will play out over the next 6 weeks. The difficulty I see with JobKeeper is that businesses that don't have any cash in them right now need to try and find a way to fund paying wages over the next 6 weeks until the government pays in arrears. So that there could be a problem there, and that may need some funding from owners or whatever else, and we'll get to that shortly about how that could occur. So once you have that understanding of where you get to and what you need to do, then you look at how you can fund it. So if there is a funding opportunity from directors and owners, I'd suggest that you need to look at a secured structure, and I'll talk about that a bit more in a minute. Or you look at other options from increasing your bank facilities, new finance facilities, or new equity. And all of those things should be talked about, and I'm sure James will talk to you about what the banks can do. but there are people who are interested in putting money into businesses, and there is still funds available in the first and secondary market because there is still a lot of money rolling around. So I think that's still a viable thing, particularly if you have a very strong business, but your working capital has been eradicated. The funding options are also very critical as part of your planning to come out the other side and go back into when we get out of hibernation and we go into spring. Because I can see there'll be a lot of businesses that won't have any working capital out the other side, and that will impact how they can actually come out of the blocks, whether they come out of the blocks charging at a very, very strong rate, or whether they come out stumbling along because they can't afford to actually do too much other than just open the doors and gradually build up. The other thing that can be part of that is if there is any concerns around solvency or any of the director obligations and things like that, and we're seeing that with some of our not-for-profit clients and other clubs and things like that, and even some of the hospitality, is looking at a safe harbour review, which gives them an independent review of the forecast and comfort around how their assumptions work. So, and Simon's just flicked up the poll and to see whether anybody has a plan as part of that. And the safe harbour review effectively reviews the plan and looks at the other options that are available. Some of those may be around your funding. The other things that are impacting funding are obviously the new structures with landlords, which was released last night, which at this stage is unclear and opaque, but has given a framework that landlords are pretty much going to have to negotiate, whether or not they like it or not. How that plays out and where everybody gets to will depend on individual circumstances and the landlord circumstances in the background. Some people will get good deals and some people won't. And then after you've got through all of those decision making, you need to consider your options and continue to monitor. If we are in a hibernation period for 3 to 6 months while the social distancing period and the sort of semi-operational period goes through, you need to keep considering that on a monthly basis or more, depending on where your funding works and how all your structure works. So things that we are seeing, practical issues that we're seeing that are benefiting. Simon, the next page.
Sorry, Todd.
That's all right.
Too many buttons to press. Let's go. There we go. That's all right.
So one of the things that we're seeing very effective, and we're even looking at ourselves as a firm, is remitting net GST receive on a monthly basis, effectively moving to a cash accounting for GST, which removes one of the major issues I see for a lot of clients and businesses that have a delay in payment. So you're creating more liquidity in your business by not having to remit the things you haven't received, but you're also not creating a debt out beyond, which a deferral of debt creates a problem in the future. We'd rather avoid that, so it just allows you to move through cleanly, and as you receive funds, you can remit it. There also needs to be some consideration as part of that as whether you adjust bad debts, because that will impact your GST. So for your corporate businesses, GST can be material, particularly if some of your clients, and we're seeing it, not paying. So if you're not going to get paid for something and you're sitting on a considerable debtor book, but you've paid the ATO, the Kerry Packer rule still applies to a lot of corporates, which is don't give them anything you don't have to at any time. So I think that's something that everybody needs to think about, and it's relatively straightforward. I understand the ATO is not against any of those sort of payment arrangements because they're going to get their money. It's just a timing difference. In terms of security for related party funding, previously that's been difficult to get through because the banks have sort of shied away from it a bit and sort of forced people not to do it. But it's a new world now. So if you're going to put money in now, I suggest strongly that you take security over it, whether it be agreed with the bank or whether it just be pushed through. And in my view, it's only fair to be able to do that. Because if you've done that and you've put your money in now in this high risk sort of scenario, you should be able to take security and ensure that if, despite your best efforts out the other side, it doesn't work, you can get your money out in priority. There's easy ways to do that, and it shouldn't cost too much. In terms of hibernation, as I talked about earlier, you really need to think about not only your hibernation plan, but what are you going to need to relaunch. You don't really need to think about that now because I think you've probably got a couple of months or a few months to get that going, but it needs to be starting to gestate in your mind and thinking about how that will work. For a number of businesses, there'll be a return to work plan for staffing and bringing staffing back up, and that'll require cash, and there may well be a gap between when the cash comes in and when you've got to start paying 100% of wages or 100% of costs again. And that's going to need to be managed because that'll be an issue that'll roll out the back. In terms of family jewels, a lot of our larger family businesses and a few that we've looked at, part of the issues here is to understand what they're doing in terms of funding and what the business is going to be doing going forward. And protecting the family jewels now has become a little bit more forefront because people can see that their businesses aren't as robust as what they thought they were. And they're also trying to protect their wealth because they see other opportunities. So there is a little bit of balance that needs to be sought through with that, but that will create opportunities for corporates to be able to invest into some of those and merge some of those. And there's some of the plans that we're seeing now at the other side, which is that people are now starting to think about how differently they could look at their business and merge it to be able to make it more robust and resilient. And that's pretty much what we're seeing at the moment. It is moving around. There are lots of phone calls and lots of things being discussed, and people are still working out what their plan is and what their issues are going forward before they actually start to make some rock solid decisions, which may happen at the middle to the back end of this month. And that's pretty much me, Simon.
Thank you very much, Todd. Excellent. I'm sure the questions are going to start coming through thick and fast that we'll get back to you later. But now I'm going to hand it over to Joel, who's going to give us an update of where we are on JobKeeper.
Hey, Simon and Todd, thank you very much for that introduction. Over the last couple of weeks, I've been having a lot of conversations with clients around a range of different support and stimulus measures that apply. And the two that I really wanted to run you through today, the ones that I'm finding the greatest deal of interest so far, are the two measures, the JobKeeper plan, and details of that came out today. It was just produced before Parliament. I wanted to talk about that one first, and then to move on to the other aspect, which is the small and medium-sized business cash boost, which is an incentive which applies to employers and remitters of pay-as-you-go withholdings. So the JobKeeper is probably the larger of those two measures and the one that I would start with here. That is the one that's got the greatest publicity. It's billed at $130 billion. The bill and the explanatory memorandum was released today. And we were really looking forward to finding out more about how that package was going to work because it was originally just a press release. That was the scheme under which for affected employers, you became eligible to receive a $1,500 per fortnight payment, essentially a wage subsidy. So a number of key eligibility criteria that you had to have sustained a 30% reduction in turnover, or for a business with a turnover greater than $500 million, a decline in turnover of 50% or greater. So it was actually covering most of the markets, doesn't cover the banks or employees of banks. And the flow on from that would be that the employers initially receive the $1,500 per fortnight, but are obliged to pass that on to employees. And what that did then was to make it possible for the entire economy to hibernate for those businesses that have been worst affected by closures or reductions in turnovers. Now, the JobKeeper is not just an employer type measure. It applies to full-time and part-time employees, but also for those people who are self-employed. It has capacity for eligibility if you've sustained a serious decline in your turnover as, for example, a contractor. I've just had a question come up here. So I've been referring to the decline of 30% for the for-profit sector. There's actually a 15% criteria which applies for the not-for-profit. And although I won't be covering a lot of not-for-profit today, one of the key aspects to determine for not-for-profit will be, of course, how it is you work out that key concept of turnover. It's a very difficult one to work out. Thanks for your question, Joe. Now, the turnover definition is one that we were very curious to understand, because when the original announcement was made, the the period over which turnover would be defined wasn't clear. It just referred to either an actual turnover decline of 30% or an expected decline, suggesting that it could in fact be multiple different periods. So it could be, for example, March or April or May. It was certainly suggested that the decline in turnover would be tested based on activity statement disclosures. So that suggested that they could be on a monthly basis or a quarterly basis to work out whether or not you'd had a 30% decline. Now, today was the day that we really hope to have a little bit more clarity, but having a look over the explanatory material that's come out with the bill for JobKeeper, frankly, I'm none the wiser as to how this works, because a lot of the legislation itself essentially sets out an architecture for Treasury to determine, together with the Commissioner, the eligibility for the JobKeeper payments, but it doesn't actually come down with any of those really key criteria that a lot of taxpayers, a lot of clients are really keen to know about. Now, I've just had another question come through from Haley here. And so if you're in a situation where, for example, you're trying to compare with a turnover based on, and you have been in operation for 12 months, the announcement actually set out there that if you've had a change in circumstance, that would be taken into account in determining what the decline was. So, for example, if you've acquired a business, that sort of resets the criteria, or if you haven't been in operation for 12 months, it would be equivalent to what turnover you would have expected for that period. I've got one more question here from Henriette. Will it be based on a cash or an accrual basis? I think the turnover there will be based on activity statement disclosures. So my understanding at the moment is that the turnover will, because it's driven by activity statements, if you're disclosing those on either a cash or an accruals basis, then the turnover would similarly be based on whether or not whichever method you're particularly applying to work out what you disclose in your activity statements. So Simon, I might chuck it out there to the next slide. So now looking here at the employer cash boost, that was the second aspect I thought I've had the greatest discussions with employers around. Certainly this one was very attractive for a lot of employers who suffered really badly the effects of COVID initially. And what does it do? Well, the eligibility for this particular product is for businesses which have a turnover, an aggregated turnover of 50 million or less. And it is driven by the disclosures that you make on your activity statement, for example, in the March period. If you do have pay-as-you-go withholding type payments, it doesn't actually matter whether or not you did withhold any amount, you become eligible to the what's called the small business or medium-sized business cash boost. And this comprises two different separate payments of an equal amount. If you are entitled to this or eligible for this amount, and it goes direct to the employer, the first payment is made just after you lodge your March BAS, and there'll be a second payment for quarterly recipients in September. And the payment has a minimum of $10,000 and a maximum of $50,000. You'll see there, we've just got on the JobKeeper from the previous slide, a question for all the attendees today. If you'd like assistance with accessing the JobKeeper cash support. Certainly a lot of taxpayers' clients have been very interested in finding out more about this, and unfortunately we don't quite have the detail today that we hoped we would. So that with coming back to the cash boost payment, what we see is that a lot of employers are looking very closely at their disclosures over the period. Just a little reminder there that already the tax office has approached all tax agents to remind them of their integrity requirements. Their concern would be that taxpayers are attempting to maximise their disclosure of pay-as-you-go withholdings for that March period in particular to see if they could, gain additional amounts as the cash boost. We certainly haven't seen any activity of that type, but a lot of taxpayers here who will be eligible for this will have entered the single touch payroll system, and that means that the tax office is receiving an awful lot of information on a granular level about amounts that are being withheld and remitted for pay-as-you-go withholdings. So it's worth keeping in mind that This is basically a measure to preserve the cash flows that you would have had for pay-as-you-go withholding for that period, not an opportunity really to maximise withholdings or, of course, the cash payments that flow on from it. Now, I might, at that point, pass it back to Simon.
Thanks, Joel. I think we'll hold the questions coming through. We'll come back to all the questions at the end that have not been answered thus far. So I'll move through to James.
Thank you, Simon, and welcome to everyone, and hello. Look, before I cover off what the banks are currently offering in this environment, I just want to give you a little bit of background, maybe on myself. I've had a long banking career, more than 25 years, where I ran a corporate banking business for St George Bank in the main, and formed HLB Debt Advisory about 3.5 years ago, together with the firm. And since that time have either been mandated and run transactions or advised directors or boards in the background on facilities of well in excess of $500 million. So I come well experienced, but I think we're all experiencing something which is very different, and I'm here to help. So as Todd sort of ran through, I guess one of the key items that he certainly covered was having a plan. And whatever plans we all had at the beginning of this year, the plans now are all changing. And it is really important, whether it's from your own business or certainly from when a bank looks to assess something, that a plan is in place. And once that plan is in place or ready, if there is money needed to fund that plan and debt is part of that solution, then you'll need to understand whether that debt solution actually fits in with what banks normally do. And you'll also need to understand if it doesn't fit inside what banks will normally do. I do believe that banks will consider things that are a little bit outside the normal versus what they would have considered even 4 to 6 weeks ago. But the most important part will be is to have the plan well tested and well communicated. And I guess the experience that myself and even my colleague Betty Preshaw can bring is many years experience in knowing what banks want and want to see in terms of approving money and approving plans. So I'll now just quickly run through, and I wouldn't be surprised if most people on the line wouldn't have seen some of this, whether it be in the press or whether it be from their existing bank already, but it's good just to have it all on a page or two. So for most of the announcements have really been around the smaller business, or what they call SMEs market in the business loans area. So what has been released, and all of the major banks and pretty much every other Australian trading bank have been approved by the government to issue these loans, and these loans are up to a value of $250,000 to help with the very short-term impacts that a business may be experiencing because of COVID. These loans are pretty much similar across all of the banks, and many are now open to accept these applications. In fact, there's probably only a couple of them smaller regional banks that are still getting this in place, but probably by Easter, I would imagine they'll all be in a position to accept applications. So the structures of the loans, and this was largely mandated by government, was that there won't be any repayments for the first 6 months. That is both interest and principal repayments. The loan would be for up to 3 years. Principal repayments and interest payments will commence after the first 6 months. There'll be no fees for setting up the loan. And generally, the interest rates sit somewhere between 4.5% and 5.5% for these loans, depending on the bank that sets them. Most banks tend to sit in that 4.5% to 5% sort of cost factor. Banks, for their existing customers, are making arrangements customer by customer, but you do have to approach your bank for these arrangements. And it may well be a reduction in interest rates, depending on the circumstances. But just as importantly, they're happy to extend maturities. So if your maturity on a loan was coming up within the next 6 months, they're happy to look at extending that for a further 6 months. If you have existing principal repayments on an existing loan structure, whether it be equipment finance, whether it be cash loans, they're happy to consider delaying or deferring those principal repayments for up to 6 months as well. They're also looking at other cost waivers for a short period of time, say for up to 3 months. But a lot of this is negotiable one-on-one with the bank or your existing bank. And but we are here to help if you need any help with the discussions with your existing banks. So that's for SMEs. We just sent out a bit of a poll that if you'd like us to contact you, certainly privately or whatever else, please let us know. Simon, maybe just the next page.
Yep, sorry. You have to press the button a few times.
So that was for more of the SME market. Before I run through for home loans and investment loans, I will say that if you are not a SME and you're a business, and the way that they define a SME at the moment for a lot of the packages is turnover of less than $50 million. But if you're not a SME, or certainly if you're borrowing more than, say, $3 million, which is sort of the APRA denominated sort of small business sort of cap. So if you're borrowing more than $3 million, then it's largely a negotiable situation. And I've certainly helped customers already extend facilities, some that have many, many millions of dollars of loans. Banks are at the moment, in terms of deferrals and loan maturity extensions, being quite reasonable. The important thing to remember is they're not actually waiving interest that is owed or principal repayments that are owed or the principal that is owed down the track. So that will need to be accounted for when you look at your plans going forward. So just to run through the residential loan customer relief packages, and these are relatively consistent across many of the banks and non-banks for that matter at the moment. Most are allowing you to ask for a 3-month deferral with a check-in at the end of that 3 months, whether it can then be extended to 6 months. And this is a deferral of all repayments, not just principal repayments. But you would need to check that with the lender that you have, because not every lender is the same, but generally it is for all principal and interest repayments. Some banks, particularly the major banks, are offering relatively attractive term deposits if you wish to lock the money away for 10 months or more. And rather than reducing variable rates significantly, quite a number of the banks are offering, compared to the variable rate at the moment, relatively attractive 1, 2 or 3 year fixed rates. And what I mean by relatively attractive, I mean in the low 2%. Outside of that, we are having a lot of success negotiating with banks in reducing variable rate loans as well. That's it, Simon?
Yeah, no, it is. Sorry, I was just on mute. Sorry, James, thank you very much for that. And you have definitely had success in reducing interest rates with banks, including my own. Thank you very much. So we're just going to open up for questions now. So if you can use the Q&A function on the Zoom, if you put your questions through there. I've got a couple to kind of start off with that come through. So Todd, I'm going to go to you in the first instance. When you're kind of looking at forecasts, what are people getting wrong with the forecast? What do you see the kind of common errors?
I think the issue with forecast is that whether it's the assumptions stand up to any stress testing and they're real. And the problem we're going to have going forward is there's so much uncertainty around, particularly revenue. The cost base will be relatively straightforward to be able to set up, but particularly with volume businesses, being able to manage what revenue is going to come through and when. They may be able to invoice and get people to take supply, but when they actually receive payment might be difficult. And that's where having a forecast where you've actually agreed a lot of those arrangements with people and build on your existing relationships, is important to do it. Because if you can show that process and understand that, you can take it to people like James or to the bank directly and say, here's how we're rebuilding it. And in the interim, we need some funding to be able to get us through, and then have some working capital funding to help us get out the other side, as long as it is reasonable. And that all goes back to that clear process. And particularly, that's going to be an issue I see in the upcoming audit period, where all of the forecasts are going to need to go through a more rigorous going concern approach. And as an auditor yourself, you know that everybody is now going to have a special coronavirus section probably in each of their audit reports, to be able to talk through what they're doing about it, what impact it's had, and what it's expected to have going forward. So to thinking about it on those bases and trying to keep it as simple as possible and documenting it. I think the big thing is about being able to document your thoughts and be able to clearly articulate what it is, because then everybody can understand.
Sorry, I've got to take mute off. Sorry. Thanks, Todd. Joel, question for you that came through. I know you typed an answer, but let's put it out to the wider group. So, JobKeeper allowance reduction in turnover of 30%. Is it based on individual companies or consolidated basis?
Yeah, that was a great question. So we don't actually have the full detail on the JobKeeper thing at the moment. So I am really trying to read the tea leaves on this one. But my reason for saying is that each business is tested separately for decline is there was a little bit of commentary that's been released on the updated JobKeeper section, which suggests that, first of all, when you're working out turnover for example, a tax consolidated group, you put it all in the same category and work out the turnover of your group, not of each individual business. But then when you go to work out whether or not you satisfy the 30% decline requirement, you actually go and look at each entity quite separately to work out whether or not each separate business actually has triggered the 30% reduction, or in some cases it'll be the 50% reduction. Some NFPs will be a 15% reduction. So my reading of that would be that you're actually looking at each business separately for eligibility. So although you might not have a situation where you reach eligibility across a group of entities or aggregated entities, you might have it on an entity by entity basis. So it's still worth having a closer look and paying attention to how the JobKeeper provisions actually get administered by effectively Treasury and the Commissioner once they come out.
Okay, another one for you. Declining turnover probably won't be seen in the quarter to, will probably be seen in the quarter to 30th of June, not necessarily in the quarter to 31 March. Does that mean you can't claim JobKeeper until July?
Yeah, that's a really good question as well, I think. So now my simple answer to that one is I don't think you have to wait and see until July, but you are taking some of a risk if you don't. And why do I say that? So the JobKeeper announcement refers to a decline or an expected decline of 30% or 15% or 50% in some cases. Now, an expected decline obviously hasn't happened yet. And so I think what we're being told here is essentially that you can anticipate that decline in your turnover for the next period in order to access the JobKeeper payments. Now, two things come out of that from my perspective would be, one, if you anticipate having a 30% decline and you don't ultimately get it, what happens? Are you on the hook? Yes, I'd say probably you are. And then I suppose the second thing would be, do you just wait and see whether or not you do it? Or I suppose one really practical risk would be for a lot of businesses, if you wait until July to actually see whether or not you do have that 30%, 15%, 50% decline in your overall turnover, is that too late? Have you already lost, half of your workforce, either because you just can't fund it or because they've gone elsewhere if you've stood them down? So I would say at the moment, you don't have to wait until July. It's just that you will take a risk if you do decide to opt into the JobKeeper system and then ultimately don't have the decline of 30% or greater.
Thank you kindly. Yeah, no, that's good. Another question that's come in. I remember reading about this myself last night. For JobKeeper, does a director of a company, or is a director of a company eligible for the JobKeeper allowance? I think this is kind of in relation to people that are I suppose, drawing money out as dividends as opposed to salary, but you might be a director?
Yeah. Okay. So because the cash boost is basically driven by pay-as-you-go withholding requirements. So all of those payments to directors are in the pay-as-you-go withholding regime. So yes, they would become eligible. Similarly, you'd probably also be eligible for the JobKeeper if you're in that situation.
Excellent. I did see if there's a partnership, there's only one of the partners that's eligible for it, so I'm sure there'll be a fight over it here. No, only kidding. And there was something around trusts as well, in terms of you could get a distribution. Anybody that gets a distribution from a trust might be eligible, but you can only actually receive it from one source, the JobKeeper.
Yes, that'd be correct. So JobKeeper, you can have a trust being an eligible employer for those purposes.
Yeah, but you can only claim it from one source. James, question for you. Will a personal guarantee be required, and will it be 100% of the loan, given the government said it's guaranteeing 15% of the loan?
Yeah, good question. Look, at this stage, banks have not been prescriptive around this issue. As highlighted, 50% of the loan is designed to be guaranteed by government if the loan does not get repaid. So if you borrow 250, 125 is effectively backed by a government bank guarantee. But I would hazard a guess, not that I've seen a formal approval yet from a bank, but I would hazard a guess that they will be seeking personal guarantees whilst the loan is unsecured in all other respects. So director type guarantees, I believe, will be generally requested.
And James, that'll depend on also the layering as well, if they have existing facilities and all of those sort of things as well. Absolutely.
And let's face it, not every situation is $250,000 enough, for example. It may then need a solution that might include that loan, but it may need something else layered on top.
Absolutely. Joel, another one for you. Can you clarify the timing of the payments for Cash Boost and JobKeeper?
Sure. So we're expecting the first payment for the small business and medium business tax boost to occur within 2 weeks of the lodgement of the activity statement. So it won't happen if you lodge earlier than 28 April. So we're expecting to see those in May. And the second small and medium business cash boost to come through in following each activity statement. So for example, we expect to see the second cash boost follow on for a quarterly activity statement preparer in the September 2020 quarter.
Excellent, thank you. Question, you might not know the answer to this, or we might have to take the not-for-profit ones offline on this, but the grants received by not-for-profits calculated as part of turnover.
Yeah, look, thanks. Thanks very much for your question there. I was just in the process of typing out an answer. This issue of turnover for not-for-profits is a really curly one, I have to say. Principally because a lot of the turnover discussion, I've said it'll relate to activity statements. In a lot of cases, not-for-profits maybe, but are not always making what we might call taxable supplies. So look, we have to wait and see, but my reading of it is, so Effie's question is, are grants received by not-for-profits calculated as part of turnover? I believe they will be. And my reason for saying that is there's already a definition within the Tax Act of what turnover is, and it refers to what's called ordinary income. So notwithstanding that your not-for-profit might not actually be paying tax on something which is ordinary income, I kind of look at something which is a grant, for example, and think that's more likely to be defined as ordinary income. So my answer, without actually knowing or reading the regulations as they come out, is that I think it will be included in turnover.
Good. James, businesses, the 250K loan, is it at a group level, or can each company have a look at it?
If they're separate businesses, my understanding is that a separate entity that's a trading entity could apply for that that grant. But otherwise it is 250 and it can only be applied for with one bank. It can't go from apply with one bank and then go to another bank. But if you are separately traded businesses, I do believe that that could be considered with their own employees. And
do you know if discretionary trusts are it's available to discretionary trusts? That's another question that's just come in.
it should be.
Should be. Right, excellent. Excellent. Right, let me turn that over. There's a few more questions that have kind of come through. They're probably going to need more specific detail, especially around employee type provisions and how they're being earned. The final poll question just that I'll put out there is if you'd like somebody from HLB to contact you about some of these things. One of the items on there is a strategy session. What we've been offering out to clients is effectively a 2-hour strategic planning session that kind of just, it's a sounding board, a fact check with the kind of business owners, senior management teams, just to go through their kind of forecasts. We send out some pre-screening questionnaires and ask for certain information prior to the meeting, but it's principally driven around with a business consultant, somebody from our tax specialization, somebody from risk, potentially somebody from debt as well, depending on the sort of requirements. But they've been very well received, and it's a really good sounding board if people want to have somebody have a look at what they're thinking in terms of their forecast and their strategy. So I kind of click the box if you want us to talk about that. But apart from that, thank you very much for your time today. Lots of questions, lots of unknowns still, but please, everybody, keep safe. Look after yourselves, your employees, and your families. And we hope that we can do these things a lot more frequently, and then hopefully face-to-face in the not too distant future. All right, thank you very much.